Hello and welcome everyone to the last in our four-part summer webinar series this year. Today, talking about Social Security and some light discussion on Medicare because they kind of go hand in hand. You can't do one without the other. Without further ado, let me give it over to our two panelists today, Scott and Henry. You guys want to introduce yourself real quick?
Yeah, of course. Thank you, Chad. I'm Henry Van Buskirk. I'm a certified financial planner here with BFSG, and my role here, I construct and monitor financial plans for individuals, businesses, and participants alike. Happy to be here, and thank you all for taking the time today.
Yeah, good morning or good afternoon, depending on where you're at. My name is Scott Solers. I'm a certified financial planner, senior wealth manager here based in the Phoenix office. Similar to Henry, same responsibilities, some investment management responsibilities in addition. So thank you for joining us today.
Awesome. Thank you, gentlemen. So before we get into this today, just a couple just comments. I think this is one we do every year, Social Security, right? There's a new class of
Mhm.
people that are coming up to Social Security age. I think for some of you, you probably attend this one every year too, just to see what might have changed in Social Security in the landscape. And then we try to bring different financial planners from around our team so you get diverse views from across the team too, because some people say take it early, some people say wait and take it late. And I think these guys have a lot of tools to help assess, like, should you take it
Mhm.
early? Should you wait? And what about your spouse and different incomes and all that fun stuff? All of that goes into that decision. It's not a one size fits all. Although I know if you use a Social Security calculator online, they almost always tell you to wait until age 70, which is just not right for everybody, right? It truly does come down to your individual situation. But with that, let me give it back to you guys. Kick it off, please.
Yeah, of course. So first, we're just going to start with that foundation for retirement income planning. We have, of course, Social Security as that base. Pensions are more or less going by the wayside. There's also just savings and investments. So think things like your 401k or the retirement plans at work or just your general nest egg for investment savings. And then other income, we like to talk about with real estate or annuity income, just that miscellaneous bucket. And frankly, if we're looking at that foundation, some of those top steps are frankly crumbling. And then the only two that we really have control over are Social Security and with investments and savings. If we're using the stair step analogy, if you're Rocky Balboa, you have a little bit less steps to go over. And hey, yo, Adrian, we did it. That's not exactly great when it comes to retirement planning because it's more onus on your retirement savings and on Social Security, which is why it's so important that we're talking about this today and what's important for you.
Yeah, Henry, good points there. I think it's important to reinforce as well that there is certainly a misconception out there that Social Security will take care of what you need. And although many find out that it's just not quite enough, it is an important part of your income plan. But
Hmm.
to Henry's point, the emphasis on savings and investments are certainly something in your control that could be key to you being comfortable. And just to highlight, as of the end of last year, the average Social Security benefit was $2,071 a month.
Hmm.
Um, and the maximum benefit was $5,181 a month. So there's a wide range there, largely dependent upon prior wages and some other factors. But we'll look at not only how the Social Security income benefit is calculated, but Henry will discuss the replacement rate as well.
Of course. And thank you for that, Scott. And what I'm highlighting here is the replacement rate based on your pre-retirement income. More of the onus is on your Social Security income check, the more to the left you are on that chart. So the less pre-retirement income, the more your Social Security check helps out with your retirement. The more we go to the right, it's still a factor that we must consider, but more of the onus becomes on the investments and savings that you built up over time. And we'll talk about strategies on what's important and when to file. We'll get into that later into the presentation, but just as a general guide, the less pre-retirement income, the more onus on Social Security income. The further right to the chart, the less Social Security income becomes important, and it's more based on your retirement savings over your working years.
Yeah, so let's talk about how those benefits are determined. So, Henry, go ahead and you can hit the slide a few times to
Yeah.
have everything
Hmm.
appear.
Yeah.
So, what they do is they take your Social Security, they take your
Hmm.
best 35 years of your earnings record, they drop the lowest five, and then they use a calculation to determine what that benefit is. So, your um, your statement that we encourage you to review every year, sometime mid-year, will show you what those running income was. And we encourage you just to confirm it because if you find a year where it's incorrect or it shows a zero, maybe there's a reporting issue, you can actually take your statement down to your W-2, down to Social Security Administration, and they'll actually update it for you. So it is important to review that so that you can make sure that that's accurate. Um, the statement that you see is on the right-hand side of this chart, and there's a bunch of information on there, but what most people are most interested in is how much do I expect to get when I turn 62 or 66 or 67 and age 70? And that part on the right hand of the screen is what's going to allow you to anticipate what that is. If you're in your younger years of working, of course, you'll want to keep an eye on that. Again, not only to see what that benefit statement, if it's accurate, but also as each year you ideally gain more in salary and more in compensation, you can see that number go up over the years as well.
Yeah. And just to add something real quick, what if you're, they say 39 quarters of coverage and you're just shy of that 40 quarters in order to qualify? Then maybe get a little creative. I have a client where she loves being a grandma, babysits her grandkids, and she's 39 quarters of coverage, just short of getting her own Social Security income benefit. She had that conversation with her son and said, hey, I love your kids. I love my grandkids, but hey, can you cut me a check for a little bit while I do the babysitting work? And then I could get a Social Security check and then we'll go back to having me do this for free. And lo and behold, she got her Social Security check. She got that 40 quarters of coverage. So just be a little creative with how you can get that benefit if you're a little bit short. And with that, we have a poll for everybody here.
I love it. Yeah, let me launch it. So again, interactive today. I think we have two polls throughout this presentation for all of you that have not been through one of these with us. I just launched it. It should pop up onto your screen. But at what age do you plan to start collecting Social Security benefits? We got three, real answers and then one fun answer at the very bottom. That I think we can
Mhm.
address that too. It probably won't exist. It's going to exist. What form it exists is
Mhm.
a different question altogether.
Mhm.
But I truly do tell people just, I mean, don't bank on it because it's likely to be reduced at some level depending on your age. But I'll share results with the group too, so you can see it. We have about 30% saying age 62, 40% are saying full retirement age, which is what FRA, which
Mhm.
might be 66 or 67, depending on your birth date. About 24% of people saying age 70, I'm going to wait and get that full benefit. And only 6% of people out here say it's probably not even going to exist. I'm assuming they're just having fun with us. But again,
Mhm.
that's my perspective. But
Mhm.
cool. Let me give it back to you guys.
What we're showing here is just how that full retirement age gets determined. And FRA is just when you get 100% of your Social Security income benefit. We typically recommend at least deferring until full retirement age for that reason. If you're needing the income before then, say at age 62 or 65 because of early retirement, and you need the money, by all means, take it early. You need the money. What you're sacrificing with that, and we'll get to a little bit later in the presentation, is just that guaranteed income growth of 8% per year. None of us on this call can promise that kind of rate of return in the investment markets. I would take that all day long if I could, that guaranteed 8%. And it works on the other side too, for if you are able to defer because you have a lot within your nest egg as far as your investments and your workplace retirement plans, for example, and can defer past full retirement age, wait till age 70, you're getting that 8% guaranteed growth for the rest of your life too on the other side. So if you can wait, defer, but if you need the money, by all means, take it early.
Yeah, and on this slide, what we're showing here is just based upon year-end data of last year when folks are taking their Social Security benefits. The blue bar chart is for male, the pink is for female at the different ages, 62, 66, and 70. These are just the averages. These are not recommendations. You've heard us say a few times here that when you take it, it just depends. There's certainly a fair number of questions that need to be asked to help you determine what that is. But there's a lot of variables. But this is just simply showing when people are taking it now. Starting next year in 2027, we'll start to see the age 67 populate as well, because that's when the full retirement age for folks are after 1960 birth date are going to turn 67.
Mhm. Yeah, so a lot of Social Security planning has to do with longevity planning. And if you can give me the correct answer for how long you're going to live, we can create the perfect financial plan for you. Life does not work in that way, so we have to plan for scenario analyses and look at your parents' longevity, look at your own health, and that helps determine what the right filing strategy is for you. Let's take a look at a couple examples of filing at age 62 and then filing at age 70, and then seeing what those break-even ages are in those two scenarios. So the first is if you're, say, needing the money and you're choosing to file at 62 and start collecting benefits at that point. What this chart is showing is on average, it would take until age 78. Like if you were to pass before age 78, then that would have been a wise decision to take it early. If you live beyond past age 78, it would have made more sense to defer within a vacuum. If we're looking to defer to age 70, then that break even age is about 82, 83 years old. And it's the same kind of philosophy. If you're debating whether to take it at age 70 or full retirement age, we look at longevity. And if you're looking at your own health history and your family's health history and nobody lived past age 80, it might make sense to take it at full retirement age. If you have longevity, like both of my grandparents on my dad's side lived to 99 years old, then it would have made sense to defer until age 70. You're going to get more income over your lifetime because of that. Now, Scott, how does all of this get taxed?
Yeah, so there was a question also in the group that this will help answer that first question about pensions. So what the Social Security does to determine what amount, if any, of your Social Security benefit is taxable is what they call provisional income.
Mhm,
And this provisional income is an IRS calculation that helps determine that. So
mhm,
um, you can see in the upper left here, so they take your adjusted gross income plus your non-taxable
mhm,
interest. So think of that like municipal bonds, half of your Social Security benefit payment, and that's what is then calculated as your combined income. And the box on the lower right then shows you that depending on what that range is and what tax filing status you have, will determine what taxability that you have. You see those numbers for it to be not taxable are pretty darn low.
mhm,
And so, most of us are likely going to be in the 50% or 85% of taxability. But a government pension, going back to that question, is calculated in your adjusted gross income.
mhm. And one thing that we want to address is what if you're still working? And that's already something that's popped up within the chat, and want to address that while we're talking here. Social Security, what they do is if you're taking it before full retirement age and you're still working, then anything above $22,000, that's where the penalties can kick in. And the agency temporarily withholds $1 for every $2 earned above that threshold. And then in that full retirement age year, they withhold $1 for every $3 earned above that threshold. After full retirement age, then there is no penalty, so you can work and then fully enjoy all of your benefits here. And what we're also talking about here on the taxation slide, this is on the federal side. So I live in California where they tax the sunshine outside my office, they tax the air I breathe, but they don't tax Social Security benefits. So keep that in mind. Check your state's bylaws on for how that works as far as the taxation is concerned, and then we can help you out going forward and do some tax planning for you. It's very important as far as relocation, something to consider as well.
Yeah, it's just because it's relevant to what you're going before you guys move on to a new topic.
Yep.
Because we had talked about like the amount of time somebody works. If somebody worked 20 years, do they calculate based on all 20 years, or they also remove the lowest paid 5 years to do the calculation?
Yeah, so if you work for 20 years, then they're just going to take a look at the highest years. Hmm.
Yeah.
Yeah, the
Yeah,
rest will just be zeros, right? And they'll just take those.
yeah. And then we can always work on that calculation for you offline if you have that Social Security statement, just so we can project what that would be.
Sweet. Thank you.
No problem.
So we've discussed how your Social Security benefit is calculated, the retirement age, eligibility, break-even points, and tax implications. Now let's shift a bit and talk about opportunities to maximize the benefit.
Hmm.
I'll touch on the first one. Henry will touch on the second and third. But the first one is strategies for couples. So, it's not uncommon that we have a couple get married, decide they're going to have children. One spouse determines they're going to stay at home and during the child raising years. And if there is no part-time income, all those years show up as zeros until they re-enter the workforce, while the other spouse is in the workforce and continues to earn income over the years. But we see examples of that, and when a client that we speak with is there, and they may need the income to help bridge any cash flow gap that they might have. One of the strategies is to have the lower Social Security benefit spouse start taking that benefit in Social Security as early as possible, and then deferring the larger income producing spouse to wait till age 70 to try to maximize the benefit there. So that's one idea that we have. Henry, you want to touch on the others?
Yeah, of course. So one of them is, well, what if you're single? Then what do you do there? We just look at what your household needs are, do some cash flow planning around that, look at the longevity as well, and determine what the right filing strategy is for you at that point. There's also some of these other more special circumstances. I'll start with the survivor benefits. These are benefits that you can claim as early as age 60 if you're a widow or widower, if you're qualified there. Or if you're caring for children under the age of 16, then you can start claiming benefits there. For example, I have a client that I work with. Unfortunately, her husband passed away in a accident at work, and then she has two young kids. She's in her mid 40s, around 45. Her kids claim benefits, she claims benefits, all on the deceased spouse based benefits. So we want to look at your situation on what we can actually do in your case. Those are very special circumstances, but just know that there are survivor benefits out there for you. The other one is just those former spousal benefits. One of my colleagues has a great story about how he had a divorcee who somewhat planned out their divorces in a good manner if you wanted to make lemonade out of lemons, where she was married three separate times longer than 10 years and was able to claim her ex-spouse's benefits for each of those three periods and then also her own. It's a pretty sweet deal if you planned it out that way. That's more of just a life happenstance. That's obviously not how people plan out their marital lives and their personal lives, but there are benefits that are available to you in divorcee cases.
Yeah, so last year there was a big legislation act passed called commonly referred to as the One Big Beautiful Bill Act. And it has caused some confusion because what was passed and what was campaigned on didn't necessarily come together, which is very typical through the legislative process. So we want to just help you identify what is fact, what is fiction, on what was campaigned on and what was ultimately passed. So I'll touch on the top three. Henry will address the bottom two. But the
Mhm.
first one is uh, that the bill uh, was going to reduce Social Security benefits, and the fact is that the bill does not reduce your monthly Social Security payments. It doesn't change your cost of living adjustments, eligibility. Uh, none of that is correct. So nothing changed there, and any claims of immediate benefit cuts for seniors were just not accurate. So that one was false.
Mhm.
The reduced taxation of the benefits. So the administration campaigned, if you recall, on no taxes on Social Security. And through the compromise of the process, what was determined was that there was a deduction that was permitted. It's called the senior deduction.
Mhm.
And for married couples, it allowed you to deduct $12,000 for the couples if you're age 65 or above and your income is $150,000 or less. And so it
Mhm.
would lower your taxable income, but not be free of taxes. So this compromise still benefited about 88% of recipients of Social
Mhm.
Security. Just to put numbers to ideas, if you have a couple that's in the 22% tax rate in retirement, that's about a $2,500 a year savings. So,
Mhm.
that's a little bit more than beer and pizza. So, everybody should
Mhm.
be okay with that as well. But
Mhm.
it does cost or cut the Social Security Trust Fund revenue by about 30 billion a year. And this current tax deduction as it sits now is valid for tax years 2025 through 2028. So for those 4 years and about $30 billion a year cut, it does have an impact on the next topic in that, or this section there, and that's the accelerated trust fund insolvency. Certainly
Mhm.
that did have an impact on it. So makes sense if there's lower tax revenue, that it would advance or accelerate the potential depletion from what was about 2034, 2035 down to between 2032 and 2033. So that's risking about a 23% benefit cut. Chad kind of referred to
Mhm.
this early on in the conversation where he felt, his comments were it's going to be around, but maybe a cut. This happens, right, if Congress doesn't act. And so there's still a lot of levers they can pull.
Mhm.
We'll just see if there's some action or not. But again, to put some numbers behind it, if you're receiving about $20,000 a year in benefit, that reduces about $4,600 a year. So that's meaningful. So
Mhm.
to be determined how this story unfolds here. Henry?
Definitely, definitely. And one thing we want to be clear on is there's no change to the eligibility requirements that we talked about earlier in the presentation. There's also no change to how the cost of living adjustment or COLA gets calculated. Within the financial planning uh, that we do, we like to be more conservative on the growth rate on that cost of living adjustment for income. We keep it at 2% for the plan typically. In practice, that has been at 3.1% over the last 10 years, and most recently, they increased it by 3.8%. So the benefits are strong and here to stay, in our opinion, not concerned about Social Security as a system as a whole. And just a little pro tip or planning tip for you guys here is we talked a lot about, well, if you're on the higher income side or you're able to save more into your retirement plans at work, then by all means do so. So then you're less dependent on the system if you're concerned about the solvency of the system going forward. The other thing is the type of contributions that you're making is also very impactful. You can also do Roth contributions. Those are just tax-free contributions. You don't get a deduction on the way in. That grows tax deferred and can be tax-free for you in retirement. And I'll just ask a simple question to the audience, a rhetorical one. If you had $1 million, would you like that to be taxable or would you like that to be tax-free? I'm betting everybody said tax-free. So that's one way that you can bolster your retirement plan by being less dependent on the Social Security as a whole and mitigating your income tax liability too. That we have a poll.
I love it. Awesome. So I
Mhm.
just launched the new poll for everyone. So definitely look at your Zoom. That should have popped up on most of your screens. The question here, again, just learning about the audience before we get into the next section here is what factors should you consider when choosing when to take your Social Security benefit? Is it just health and life expectancy? What about living expense or investment portfolio size? Or other retirement benefits that we've already talked a little bit about, right? Do you have government workers maybe, or have access to a pension? How does all that impact? Um, this is why I love our audience because
Mhm.
almost everybody's already responded, but let me close out this poll and I'll share results with the group. And you know, very few, less than 10% for the top four options. Almost everybody is spot on. You need to look at all of the above in trying to figure out when you should take Social Security, right? I mean, delaying Social Security to maximize the benefit, but depleting all of your retirement assets like 401ks, 403bs, 47s also might be the wrong decision, right? Like you want to kind of balance the entire approach across these things. But let me give it back to you two to kind of talk about that a little bit.
Yeah, definitely, definitely. And I know that that is something that people think about and just try to outperform that 8% guaranteed return. I mentioned before that if I found an investment greater than that, then I would put all of my money there. It's extremely hard to have that kind of guarantee going forward. If you have a hot tip or something like that, then there's a reason those things are typically hot tips, in my opinion. So I would agree with Chad on that strategy, not try to take it early and then just the amount and you're investing the difference to try to outpace what you can get from the administration. I would look at everything here that we talked about in this poll and everything that we've talked about in the presentation before making that decision on when to file, definitely.
Yeah, I
Yeah,
think everybody thinks they're going to make 8% returns, and you swear you're going to make 15% and beat the markets. The reality is like a guaranteed 8%. Like any advisor that tells you they can guarantee that is lying. And
Or is
you
Birdie
want
Madoff?
to,
Yeah.
right. Um,
Yeah.
I think most experts out there, right now, the ranges from all the big banks and financial organizations are somewhere between like 4 to 8%, right?
Hmm.
Annualized over 10 years. But that also means staying invested the entire time when the market's up and down to get that average rate of return. So it's
Hmm.
like a guaranteed 8% is hard to come by if you try to take it early and beat 8%, that's going to grow.
yeah, that poll just reinforces that there are just too many variables, right? And the answer earlier was, when we're asked the question, when do we take Social Security? And it depends. There are too many things that we need to weigh, and that's why it's important that here at the end you'll have the opportunity to jot down our contact information and have that
Hmm.
conversation with Henry and I, or
Hmm.
some of our other financial planners to help
Hmm.
provide some clarity as you move forward. So what you're looking at now, this next slide is really a tool that we use, and it compares two different strategies. This one that we're looking at is on the top. If you're given life expectancy, and that's typically what we use is the Social Security mortality table, and then the
Hmm.
one on the right is what if you have extended or longevity in your family? What does that look like? In the chart down below, again, just another example of break-even point uh, guideline for you is, what happens if that person lives past 79, right? And they took it early. Well, they would have been better off waiting till 70 because they would have had a higher benefit amount. And you can see on the purple bar there is early, and the second one is primary, the one that we're using is age 70. And so you can see there's a meaningful difference in the lifetime benefits that could be received. Again,
Hmm.
another example of financial planning is not black and white, but rather
Hmm.
shades of gray. And so your
Hmm.
needs are unique to you, and that when do we file really needs to be a discussion with one of us here, or
Hmm.
financial planners, so that you can have the tools needed to confidently file for Social Security in that time frame you want to file for Social Security.
100%. And we're going to shift gears and talk a little bit about Medicare. Like Chad mentioned at the onset, you can't talk about one without the other. With Medicare eligibility, we're just showing the basics here on who is eligible. Typically, it's seniors when you get to that age 65. That's when you would sign up for Medicare. And we'll get into Part A, Part B, and the ins and outs in a couple slides here. And it works very similar. It's 40 quarters of coverage. You had to be a US citizen to get Medicare, and that's the basic for everybody. If you're disabled or if you have end-stage renal disease, you're on kidney dialysis or some other health-related conditions, they post online Medicare.gov. You can check if that's applicable to anyone in your situation, if you can become eligible for Medicare. The other one here is that spousal benefit. If you have a working spouse and non-working spouse, then the spouse can also get on to Medicare, assuming that the working spouse would also qualify at that point. There's also some special circumstances to consider. In the divorcee case or the widow case, you may still be able to get Medicare coverage, even if you yourself wouldn't have received Medicare on your own. And that's something that we can take a look at offline to see if that's applicable in your case. But just know if you are in those special circumstances, you may still be eligible for Medicare.
So on this slide, enrolling in Medicare, when do you do it? So there's a lot of information in here, and I'm going to share quite a bit of detail. And the reason that I'm going to do that is because there are some unique quirks with Medicare enrollment. And the whole purpose of sharing all these details is so that you avoid coverage gaps with your insurance as well as potential penalties. So it's really critical to understand how Medicare enrollment works. So the first one is the initial enrollment period. And so what this period is it's a 7-month window around your 65th birthday. So you have the month of your birthday, 3 months on the front end, 3 months on the back end. We certainly recommend that you sign up for Medicare when you turn 65 so you avoid those coverage gaps. And if you're already receiving benefits from Social Security prior to age 65, you're going to be automatically enrolled in Part A and Part B starting on the
Mm-hmm.
first month you turn 65. But there are some unique things that need to be considered during that initial enrollment period.
Mm-hmm.
One is if you file during the first 3 months before your 65th birthday, then the coverage is going to begin on the first day of your birthday month. Okay. The second is if you file during your birthday month, then your coverage begins the next month. So if you have an August birthday, then your benefits will start come September 1. If you file on the 3 months of that window, during those 3 months, coverage begins 2 months later. So hope you heard that correctly, because that's one of those quirks that we were telling you about, that we want to make sure that you avoid a coverage gap. So if you
Mm-hmm.
stopped working at 65 in August, you turn 65, but then you didn't start your filing for Medicare until September or whatever month it is after that, it's going to begin 2 months later. So you're going to have a period of at least 2 months of non-coverage. So you want to be careful there. It's also important that if you're enrolled in Medicare, you need to know that you are not able to contribute to a health savings account,
Mm-hmm.
oftentimes referred to as an HSA account. There is a working exception, of course, that if you're still working for a company that has more than 20 employees and you're covered by a healthcare plan, then you're good. But the
Mm-hmm.
quirk here is that you have to stop your HSA contributions 6 months before you receive Medicare. So you still have to plan. So that's just the initial enrollment period. So let's say you miss that altogether. You get to the general enrollment period next. And so that's every January through March. You can then go in and do the open enrollment during that period, or general enrollment during that period. If you enroll in Medicare during the general enrollment period, your coverage begins in July. Again, if you
Mm-hmm.
heard that correctly, if you're like, whoops, I missed it, but I'll just do it in January and get my benefits right away, it's not going to start till July. So you're going to have a gap in coverage for at least 6 months there, if not a bit shorter. Okay, so it's really important. Well, what if you're working and you're covered by a company healthcare plan? Then yeah, and you can work past 65 at that point. You have then the special enrollment period. And
Mhm.
again, as long as you or your spouse is working and you're both covered by a healthcare plan, you're good to go there. But once the coverage either ends or your employment ends, then there's that 8 month special enrollment period to sign up for Part A and Part B. That starts the month after your employment ends or the group health insurance ends. So whichever happens first. So it's always a good idea also after you're enrolled that during the open enrollment period from October to early December of every year that you reevaluate your choices to make sure that they best suit you.
Hey guys,
Mhm.
before you leave this slide, just a
Mhm.
reminder for the group, do please type your questions into the Q&A box, which is different from the chat box, and everybody else can see them and thumbs up them as well, instead of the chat, which sometimes comes just to us, sometimes goes to everyone. But I have one on this page, the special enrollment period, confirming that the Medicare special enrollment period only applies if you're on an active employer group plan, not a retiree employer group plan. Is that correct?
Yeah, that's my understanding,
Mhm.
Chad.
Yep.
Yes.
Yeah. And with that said, let's get into the ins and outs, what Part A and Part B are. Part A and B combined is what original Medicare, that's what people think of when you say Medicare and what that covers. Part A, think of it like the worst hotel stay that you've ever had. And right when you get in, right when the bellhop checks your bags, then you want to get out. But hey, at least it's clean because you're in a hospital. So you don't want that kind of situation to happen to you. Obviously, you want to be in good health, and you can't be denied this kind of coverage. And what happens if you do need that hospital stay, then for the first 20 days, you're completely covered, nothing on the hook for you. From day 21 to day 100, then you have co-insurance, so you have to pay some of that hospital stay. After the 100th day, then you're required to pay the full bill at that point. There's also a misnomer that this covers long-term care. It does not. We can get into if long-term care is important for your household, either offline or later in the Q&A. But in general, that's what Part A covers. Part B is more of that outpatient care. So those are your doctor services, those preventative care, so you don't have to check into that hotel of that hospital. And Part B and Part D, we'll get into how that gets calculated as far as the premium payments and how your taxes get impacted by that as well. But again, Part A and B combined are the original Medicare. Part D, that's prescription drug coverage. And you might hear on the news recently, even in the last week or two, that they're looking to stop the government subsidy for that. This is not a political statement at all. We just look on current law and then we just shift accordingly. So whether it goes up or it goes down, we will deal with it at that time. I had that little teaser on how Part B and D gets calculated. That's based on IRMA. Now, IRMA is not a friendly girl, and what IRMA stands for is the Income Related Monthly Adjustment Amount. And that's all predicated on your modified adjusted gross income. So not only do we have to look at that provisional income for Social Security and how that gets taxed, but we had to look at all the sources of your income to determine what the premiums are for Part B and Part D. And it's based on a cliff schedule. So it's not like how you're used to with your basic income taxes, where it's a progressive system. Say you're in the 22% bracket, and then you're inching into the 24% bracket. It's not like every dollar you earn after that point is taxed at 24%. It's just those additional dollars in the 24% are taxed at that higher rate. In the case of Irma, why she's not so friendly is that when you get above that next tier, when you're in that next tier, it's a cliff. So then if you're $1 over, then each monthly premium for Part B and D is at that higher rate for the rest of the year. And they base it on a 2-year look back based on your prior 2 years tax return. So for 2026, they're taking a look at 2024 income. We're also going to just highlight, well, what if you want additional coverage? Well, you have a couple options. You have the supplemental plan or you have an advantage plan. And to help describe the difference between the two, I'm just going to use my own family as an example. My mom is a retired nurse from Kaiser, and through Kaiser, she gets full coverage for a Medicare Advantage plan through Kaiser. And that what that does is from Part C, which is just taking Part A and B, making that into the private insurance of Kaiser, and everything is covered there. And then prescription coverage is also covered through Kaiser. Then she doesn't have to worry about that, but she has to go to Kaiser for everything, for blood work or any hospital stays or preventative care. The other side of that is on the supplemental plan, where you just take the original Medicare, the prescription drug coverage, and then you tack on additional features that are optional. And my aunt signed up for this because she's an avid traveler. She had to use this and she was on the Medicare Supplemental Plan F, which is beneficial for traveling overseas, and she broke her leg in Ireland. She had a lot of subsidy from the government for being on that Part F plan, and her out of pocket was very low because she chose to pick that optional coverage because she knew that she's an avid traveler and loved to hike. So that's the basics between the two, and we have some of these highlighted on the next slide. And Scott, if you want to chime in on anything I might have missed here.
Yeah, nothing that you missed on the prior slide.
Okay, all sounds good. So from here, this is just a summary of everything that we went over. We addressed a number of different questions. How do I file for Social Security? How do I sign up for Medicare? And how do my taxes and tax planning get impacted by all of these things we just talked about? Well, for Medicare, Scott has a great one-pager. So you keep track of those different dates to keep track of. And then if you're part of an HSA, those different rules and the excise tax and just all of those things to be mindful of when you're going to sign up for Medicare. We also have great resources that we can refer you to if needed that can help you shop for those right, say, supplemental plan. If you are an avid traveler in that example that I use, what's appropriate for you and the kind of plan. For Social Security, that chart that Scott went over a few slides ago before we started talking about Medicare, that took 5 minutes to come up with our tools that we have. If you're concerned about when do I file for Social Security, how do I do that, what's appropriate for me, then just give us a call. It takes 5 minutes of your time. We sort out what the right strategy is for you so you can go file in style. And with the tax planning side of things, we also want to take a look at your tax return. Chad hates taxes. Scott and I love taxes, but we'll go through your situation and see what we actually need to be aware of, like the IRMA that I talked about a little bit earlier, that income related monthly adjustment amount, or just if you're impacted by that provisional income and your Social Security income is taxable or not taxable. So we'll take a look at all of that. It just takes a few minutes of your time and a quick call to us.
I feel like Henry just said he loves taxes. That was what happened.
Yeah, I'm a weirdo.
Yeah.
Someone has to.
I love the jokes.
Yeah.
Cool. Thanks, gentlemen. So as always, right, ways to get in touch with us, and always financial planning at bfsg.com. If you have very specific questions for yourself, we did have one of our other CFPs, Paul, come and join us. So that he could type some your responses back to people in the chat box too. Because this is a national audience on here too. Some responses we will say, please reach out to us directly. They're very personal in nature. Meetings are always complimentary depending on your employer. If you're coming from like a 401k or a 403b or governmental plan that's a client of ours as well, oftentimes the entire process is complimentary. So I definitely would reach out and we could talk if there are fees, what those are separately. Again, we try to keep these purely educational, not selling anybody on coming to talk with us. just making it information, although we're always happy to talk to you separately. So with that, guys, I do have a few questions in here. And again, reminder for everybody, please do keep typing questions in the Q&A box. I did already post a link to the survey, a link to the PDF slides in case you're interested in them in the chat box for everyone.
Hmm.
We understand some people will have to drop at the top of the hour, although we will stay on the line to continue answering questions until the very last question is addressed. So I know that can, 1 year this extended all the way to 2 hours because we had so many questions coming in. And we're happy to keep them. But I did just want to post that stuff in the chat box for those of you that might have to leave early. So the first one I have in the chat box comes down to, you mentioned Roth, right? And having a tax-free bucket for, somebody that just, their employer just added Roth contributions to to their retirement plan. You think again, 457, 403b, 401k program. Most plans allow it. It's still not in every plan out there though. If some plan just added that, or maybe the plan's always included it, but this person's never saved Roth. If they're planning to retire at the end of this year, would it make sense for them to start contributing to that Roth bucket at this point in time? Can you talk about kind of pros, cons, keeping it general? Because again, we don't have all the individualized tax situation that this person might have to go to. But what are your thoughts?
Mhm. Yeah, I can take this one. So what the planning around that is, if we're keeping things general, is the closer you are to retirement, then Roth isn't going to be as impactful as in early years. If you're, say, in your 20s and 30s, then by all means, Roth is most likely what's going to be best for you in your plan. What you can do, depending on your age, is you can always move money into Roth after the fact by doing a Roth conversion, where you're voluntarily taking traditional monies in, say, a traditional 401k, and then converting some into a Roth 401k or Roth plan, whatever the situation is. That's a taxable event at ordinary income. So after you retire, sometimes there's a window that you have available to you where your income is a little bit lower. But again, putting on the tax planning hat, I don't want to waste, quote unquote, a low income tax year. So then that might be where we voluntarily put some money into Roth so that that can grow tax free for you. It just depends on your situation. I don't, of course, like using the it depends situation, but we can take a look at that offline and see what's appropriate for you going forward.
Yeah, I would
Right.
add on to that as well
Yeah.
is again, I'll say it depends. Depending on outside, if there are other Roth assets, the Roth IRA could be used as an estate planning tool as well.
Hmm.
Of course, the tax-free inheritance, there's no lifetime benefit or R&Ds with it. There's no 10-year distribution window. So there could
Hmm.
be benefits, but we would need more information to more accurately answer that. And my example would be dependent upon other Roth assets outside of your 401k.
Hmm.
Yeah, I think the biggest piece to take away from that is the 5-year clock, right? Like you can't
Hmm.
touch it for five
Mhm.
years. So if
Yeah.
you do start saving, just know that you need to pull from your other pre-tax and other investment accounts before you touch that Roth money. Otherwise, there will be a penalty for it.
Hmm.
Right. Okay, so the next one I have for you all, this goes back to Medicare. Does Part B cover dental and vision?
It does not. It does not. You would have to do either Medicare Part C or one of the Medicare Advantage plans or Medigap.
Yep. Awesome. And then next one I have for you about the special enrollment period for Medicare. Say I enroll in Medicare within 8 months after my employer healthcare plan ends. After I enroll, when does coverage begin? Does it begin right away? I think this is where you said, there's usually a 2 months, so that you want to plan ahead to bridge for a 2 month gap.
So not in this
Hmm.
scenario, Chad. This one would be the month following either the termination of employment or the termination of that insurance plan. That coverage would start the following month.
Hmm.
Got it. Easy. Awesome. Okay, next one I have for you is, can you say again, you said it earlier, citizenship, in the US being required for Medicare, and how that might, like, what if
Hmm.
somebody moves abroad, how
Hmm.
any of that might impact.
Yeah, so typically you need to be a citizen for 5 straight years, then you would be able to qualify for Medicare. as far as moving abroad, if that's where you're looking at, then it depends on if there's any reciprocation. We need to take a look at that online because offline because it depends on where you're looking to relocate to as an expat on if you would still get some kind of Medicare coverage. Hmm.
Yep. Thank you, sir.
Hmm.
So the next one I have is, so what do we think about long-term care? And when might somebody want to start to sign up for it? And for this person, I'm going to put another link in the chat box. We actually did an entire session on long-term care in our last summer series in 2025. So I'll put the replay for it. It is on our YouTube channel and our website. If you want to go deeper, I think these gentlemen can help answer that, up front. But I think the webinar goes really deep into some considerations and explaining what long-term care is, and when you might want to self-insure versus when you might want to pay to actually get coverage.
Yeah, so then with long-term care, we start looking at insurance. So there's a couple different ways you can fund long-term care. You can self-insure, which is just like it suggests you have your nest egg and then you're using that to fund any expenses. Or you can buy an insurance policy. There's different kinds of insurance policies that are available. And we typically look at using long-term care insurance when you're in your early 50s, because that's when it's most economical for most people. If you're in your later 60s or early 70s, then the premiums would typically be too high and for something that you frankly might not use. The stats are that majority of people, if you're a married couple, two-thirds need some kind of long-term care benefit. So that's not 100%, right? So you might not use that. That's why we take a look at your whole plan to see if you can self-insure. But again, Medicare doesn't cover long-term care expenses. And I would definitely check out that webinar that Chad posted. It goes more into the ins and outs of long-term care and what to plan for in that case. But long-term care and healthcare expenses in general in retirement are by far the highest expenses that people incur.
Yeah, I would add or
Hmm.
just reinforce, Henry, that
Yeah.
really planning becomes a great component of here to even project whether or not you can
Hmm.
self-insure and
Yeah.
avoid the expenses. And
Yeah.
you're right, when you start hitting 50, the costs really start going up. And so
Yeah.
if you haven't done the planning, to determine if you can self-insure, it's really important that you give some strong consideration during that time range because there is no other insurance policy, Medicare that we're talking about here,
Hmm.
that will cover it. And the expenses can be quite high depending on what type of care and what type of facility you're in. Genworth has a great national database that you can look at costs in your area down to your zip code.
Hmm.
And so maybe start there to determine, do I need to do some planning around this? Do I need to have some consideration around long-term care insurance?
Hmm.
Awesome. I'm going to do another one too, because there was some questions around it. We kind of talked about it, but I'm going to put another
Yeah.
link in the chat box before I get to the next question.
Hmm.
Because it was part of this summer series, but I know not everybody attends, all four sessions that we do in the, during the summertime. The
Yeah.
second one we did, if you did not attend it, was on bridging the gap, the healthcare gap before
Hmm.
Medicare eligibility, right? Like you might think or know you're going to retire at 65 or even later than 65. But statistically, most people actually retire at age 62 or 63. And so
Hmm.
what if that actually does happen to you, whether you want to or are forced into that?
Hmm.
And what are your options to continue having health insurance and health coverage until you are Medicare eligible?
Hmm.
The next one I have for you is we have a couple just on like when to apply that might be very specific, but for like the Medicare 2-year look back, do the following
Hmm.
2 years matter in terms of income before the year I turn 65?
Yeah, it's
Yeah.
oh yeah, sorry. I could take that, Scott. So then how they do that is when you turn age 63, that's when the clock starts, and that clock goes the rest of your life. So when you turn age 65, they're looking at your income at 63. When you're 64, 66, etc., then that's how they're calculating all of that. So we have to be mindful of your tax situation in those years. Something that you can do is that if you do see a market increase in your premiums because of an event like a home sale, for example, my parents, when they retired, they were past age 65, and then they had a capital gains event from selling my childhood home of 30 years. So then when that happened, they filed SSA Form 44 and then explain that this was a one-time event. Our income is not normally this high. Then please do not penalize us for increased premium payments. That's why tax planning is so important, so that we can give those reasons if you are in those gap years or you're in a retirement year and you are shifting to your investment income instead of your W-2 income. We can take a look at that offline for you.
Yeah, another area that's often sneaks up on people is Roth conversions.
Yeah.
That all counts as ordinary income, and that can throw you into some pretty high premiums. So again, just stressing the planning ahead of time. That clock is always running, but depending on several items. Not saying that you can't do it, you just may have to be using the Roth conversion example, just might be a multi-year conversion, just so that we don't pop you up into a higher tax bracket or IRMA bracket, excuse me.
Mm-hmm.
So the next one comes to, again, going abroad is if we look at abroad, will the amount of Social Security decrease?
It does not.
Yep. Awesome. You're already claiming it. Next one, this is again the specific date. So let's just do some math on it. But if somebody's turning 65 in August 2027, what is the optimal time that they should be applying for Medicare?
So the earliest you can do it is 3 months prior to your birth month, in this case, August. So that would be what? That would be May,
May.
June, July. Yeah,
Mm-hmm.
May would be the earliest. And if you did that, then your benefits would start on the first of the month of your birthday in August.
Mm-hmm.
Yep. Awesome. Okay. So next one is when trying to calculate, anticipate future IRMA brackets, is it best practice to assume that IRMA brackets will increase at roughly the rate of inflation, right? i.e. bracket ends at 200K, that same bracket ending amount will increase each of the next 2 years?
Yeah, for IRMA planning, there's two different ways that you could go around that. It could be just doing a little bit lower than the base rate of inflation. I like to use 2%. Or if you want to be really conservative, you can just assume 0% on that. And then we would just look at your current situation and see if you are close to that next tier, just to try to avoid you. But most conservative, no inflation, and then you would just adjust that every 5 years or so, because realistically there is going to be inflation on these things.
Yep.
But
Yep, agreed.
okay.
Cool. Honestly, guys, that is the last question we have from the group today. It sounds like you guys addressed almost all the questions just in your main remarks. I even saw a couple of them get like withdrawn while you were going through your presentation. Any kind of closing remarks for the group before we wrap this one up?
Yeah, I would add a couple. We've stressed the importance of planning, going through a financial plan, this whole presentation. And Henry had some great comments, and I hope it resonated with you right on the first slide with the rocky stairs, is that both you can control your Social Security benefit and you can control your savings and investments. And so to some degree, those factors are in your fingertips. And so please take advantage of the information that you can gather, that we can provide for you, that we can help you with, whatever the case might be. But certainly you have control over this, so take control.
Yeah, definitely, definitely. And just to echo that, stress about things that you can control. Don't stress about things where, oh, well, the government's going to do this, this person's not in the White House or in the White House. Don't stress about that kind of stuff. Look at current law, look at your current situation, focus on this year and next year, because that's reasonably what we understand and can control. That's what financial planning does. And we can do that for you. And it just takes a simple call to us and you can get a lot of your questions answered in a simple 30-minute meeting. But to put together just that Social Security presentation, that's like 5 minutes of time. And to address these questions, it's pretty straightforward, but all of this is comprehensive. So we would look not just at Social Security or Medicare, we look at if you're, like Scott mentioned, looking at estate planning or inheritance for your heirs, what to do in those situations, and is that even important to you? That's what the financial planning process entails, and we're happy to do that with you guys.
Yep. Okay, guys. Well, as you're giving all these
Mhm,
remarks, we got a new one coming in. We did a webinar on this, I think, last summer as well, though. But before we truly wrap up, and again, thank you for everybody that stuck with us. But like I said,
mhm,
if we have a question, we're going to answer it.
mhm.
So, what are your guys' thoughts on rolling your pre-tax or Roth accounts into growth and accumulation fixed index annuity? I'll try to find the webinar replay from last year where we really talked about this. Um, to kick out the myths, but I'll let you guys take it first.
Mhm. Yeah, so annuities as a blanket vehicle are not inherently bad, but they get bad rap because people get put into bad situations. And unfortunately, a lot of the times you don't need an annuity, frankly. I don't know your specific situation, so I'm just speaking in blanket terms. But fixed index annuities, they promise a lot, but then if you're looking at the actual investment performance of the underlying index options, it doesn't really do a whole lot. I can give you client after client example where they started a fixed index annuity in 2018. The income base, which is how they base the actual income you would get when you choose to use the annuity, keeps growing, but their actual money hasn't moved. So what's up with that? It's because there is a lot of fees that go into the annuity and how they calculate the actual index options. We can get into the weeds on the specific product, but most of the time, if you're looking at just moving your money, rolling it over into an annuity, I like to take a look at SPIAs or single premium immediate annuities, where you're just making a pension for yourself. And maybe that rate of return on the pension is 6%, so you get 6% of your income into perpetuity for the rest of your life. That might be appropriate for you if you have things like fixed expenses that aren't going away, like property taxes don't go away as much as we would want them to. They stay for the rest of your life. Those kind of things, if you want to guarantee that through an annuity, you certainly can. But most times they're not appropriate just because they are inherently pension replacements and they're not investments. So don't think of it like an investment.
Yeah, I would agree. I would just add to it, at its most basic level, it's hard to uh, be okay with a tax deferred vehicle or another tax deferred vehicle, putting it into another tax deferred vehicle. I think you would be shocked at the level of fees that are inherent that you're not currently subjected to, or not likely currently subjected to. So I
Mhm.
would just be cautious and make sure that somebody reviews the details with you. That's not the insurance agent.
Yeah. And to use that example, if you're in the pre-tax bucket, putting that into a pre-tax annuity, then think of it like you're wearing a poncho. It's raining outside, but you're inside. You're definitely not getting wet, but did you need to pay for that poncho? Probably not. If it's a non-qualified annuity, then that might be a little bit of a different story, but just use that as a guideline.
I
Yeah.
don't like, sorry to interrupt, guys. I don't like to give blanket advice as a financial planner. This is one of those very few times I will give you blanket advice. Never put Roth money inside an annuity. You're taking money that's growing tax free, turning it into tax deferred growth. So never, ever put Roth money inside an annuity. I cannot stress that enough.
Yeah.
That's my two
That,
cents. I will get off my soapbox.
and since Paul
No.
since Paul jumped in, he's been answering questions in the background for some of the like the easy low hanging or
Yeah.
very personalized ones in the chat.
Yeah.
Something I hear from Paul all the time too is annuities are not bought, they are sold, right?
Yeah.
Like nobody goes and finds an annuity agent and says, "Hey, I would love to buy an annuity." That's rare. It's annuity salespeople that are out trying to sell you on why their annuity product is so good. There's just a lot of just nonsense in their sales pitch, right? They're expensive. They make huge commissions on those things. And then they're just hidden fees, right? Like an index annuity caps your upside in almost every case, while not really capping your downside necessarily. So, in most cases, that extra insurance you're paying for, if you just invest it appropriately, you will way outpace the rate of return that annuity is going to give you. They are correct for a very small subset of people, right? Peace of mind is something that nobody can give you, right? Investments are not going to give you, a great, perfect streamline of gains every single year. And if that's important to you, then maybe an annuity is appropriate. But just definitely evaluate it and talk with somebody that's not an insurance agent before you go dive into those.
Yeah, and just real quick, we are not trying to sell you on insurance. I was insurance licensed before working here. I voluntarily gave that up to give up any potential conflicts of interest. All of us here are fiduciaries, so we work with your best interest in mind at all times. And we're well versed in this. A lot of us were, in my case, we were able to sell things like long-term care insurance or annuities or things like that. But we gave all of that up so that we can put your interests ahead of our own and avoid any conflicts of interest. So we're not here to sell any kind of product.
Awesome. Okay, so I got another one since we're doing the annuity conversation. Some people have questions on annuities, like one from Delaware. What about the health riders and annuities? Some pay out larger amounts for 5 years if you get a qualified illness. These things are so confusing.
Yeah, and what you're referring to is a nursing home waiver, most likely, because there's a couple different things that it could be. It's most likely a nursing home waiver. And depending on your state, you can get a higher income. So easy math, you normally could get 5% of income for life. If you qualify for that nursing home waiver, then it's 10% for a period of time if you have a qualifying illness. And that's usually similar to how long-term care insurance works, where you can't do 2 out of 6 activities of daily living. And those 2 out of 6 activities, like you can't transfer from bed to chair on your own, you can't feed yourself. Those types of illnesses are what they look at with the annuity. On the long-term care insurance side, there's just the simple, well, I don't qualify for 2 out of the 6, then you get a stated benefit. Or there's life insurance payouts where you can take your death benefit early in the form of accelerated death benefit if you qualify for those types of things. So there's lots of other kind of planning that we can do around that if that is a concern for you. The nursing home waiver thing, honestly, is just something that insurance companies have tacked on in recent years because it sounds nice and they're trying to help benefit people who didn't buy long-term care insurance or understand that that's a problem in the future. But it's more of just a sales pitch in most cases, to be honest.
I love it, gents. Thank you for answering. So again, as we wrap up today, Henry, can you put that disclosure slide so our compliance team doesn't murder me? Thank you everyone for sticking with us today. We hope you enjoyed not just this webinar, but the entire series. Do please fill out that survey and let us know topics that you think would be interested. We will be back again for our fall series later in 2026 that we usually put at least 3 or 4 sessions together. We can always come up with topics between ourselves to rinse and repeat or new topics, but we love to get ideas from our attendees, what you would like to hear to help guide what content we should be promoting. Right? We always think we know what people want to hear, but we love to get that guidance directly from you so we could put something together customized that will be beneficial to you and all of your employees, family, and loved ones. Again, thank you all for attending today, and we look forward to seeing you at another session coming up soon.
Yep, thank you.
Yeah, thank you everyone. Appreciate it.